So your first impression of those numbers, because we had a trading update a couple of weeks ago that said expect something from 10 to 25% lower. They came in just over 18% lower. Were you shocked?
Look, I mean, certainly it's never easy to see a number so far down. I think they've done a pretty good job of guiding the market to expecting a poor number. So a lot of the bad expectation was already, I think, simulated in the market. But I think what really hit the share price today, beyond just the poor results reported today, is an outlook for the next year that is, frankly, not a whole lot better than what we saw for the current reported period. A lot of the initiatives that they've been working on for the last couple of years, seems to be taking a bit longer to implement and come to fruition than certainly they had originally intended, and I think what the market had originally hoped for. So I think as analysts go back to their desks and start figuring out what this means for the outlook for Pick n Pay over the next year or two, I think you're likely to see people's expectations come down a little bit further still.
They've had a lot of factors working against them over the past year, and they mentioned that in the trading update as well. They had the strike just before Christmas. They've had rising input costs, which they haven't been able to pass on to the consumer at this stage. And then they also had the whole thing with the Australian competition authorities, where they haven't managed to sell Franklin, and yet they are trying to grow their distribution network or get a distribution network in place here, which they have to raise money now for.
Yeah, look, I mean, it's been almost the perfect storm for them. So you mentioned Australia, that's been a distraction for them. It's come at an inopportune time. It's effectively a little over R1 billion that's trapped now in Australia, and seems to be riding in the balance at the whim of the legal system in Australia. So that's come at a time when they're having to ramp up their capital expenditure budget in South Africa. As they're building out distribution centres, that's consuming a lot of cash. At a time when trading conditions are tough. So it is a bit of a disadvantage for them having that money effectively stranded overseas. But beyond that, if you look through the numbers line by line, it's been a pretty tough period, and I'm not sure you can ascribe all of the damage purely to rising input costs. If you compare turnover growth or sales growth between themselves and their primary competitors, it's probably about 3% slower than what Shoprite and Spar were doing over the comparable period. And most of the difference there is literally just feet into the store. They haven't been able to pull their customers into the stores at the same rate as their competitors have. And as a result, what we've seen over the last couple of years, market share losses to some of these competitors looks like it's continued. And it's not clear at what point or what's going to make that stop. So they've launched a loyalty program that they're quite optimistic about the impact on market share from that. But it's still early days. We're seeing almost reporting period after reporting period, better market share gains from their two primary competitors, and that's been a challenge for Pick n Pay in the last 12 months.
There also seems to be a question mark over where they're actually positioning themselves in the market. So at the lower end of the market, you have Shoprite, maybe to some extent Spar, just because it's convenient. The upper end of the market, you have Woolworths, and Pick n Pay is somewhere in between that. Do you think it needs to be more decisive on who it's actually aiming at for its customer base?
Yeah, I mean, there's no doubt that it's difficult to be everything to everyone. The heartland Pick n Pay customer is still the upper middle class consumer, what we call LSM, 8 and above. But increasingly, the growth in the market in general, is from the lower end. And this is a market that still has some opportunity for retailers like Pick n Pay and their competitors to formalize, if you will. So whether or not the operating model works all the way through the population, the kind of your consumer demographic curve, I guess that's up for debate. At this point, where they have entered into lower end markets with the Pick n Pay brand, they've been fairly successful. The stores that trade typically franchised to an individual businessman, but trading under the Pick n Pay banner, they seem to trade quite well. So I think the format works and the extension works, but it does create a lot of operational complexity in the business, trying to match the same type of merchandise and price points that you have at the upper end of the market with something that needs to appeal to a lower end demographic as well.
Well, those shares are down 5.5% today, just below 42 Rand. So losses for the year down by about 9%. Do you think that's justified given the uncertainty and given the negative outlook for the retailer going forward?
Yeah, well, look, I mean, the stock is not cheap in absolute terms. If you compare the valuation of our food retailers to some of the other retailers in the sector, a stock like Pick n Pay is still, even after today's losses, trading at quite a substantial premium to names like Clicks in the sector. So it's a stock that has been priced for an operational turnaround. And I think what the market is recognizing, certainly in its reaction today, is that the duration of time that's going to take for that turnaround to come through might be a bit longer than we'd all originally anticipated and hoped.